Okay, good afternoon and good morning, everyone. Welcome to this webinar, which is being held with Institutional Real Estate Incorporated and EPRA, the European Public Real Estate Association. Thank you to all of you for taking your time out of your busy schedules to join us today. We sincerely hope you find today's session valuable. I'm Marek Hansel, and I'm the editor of Institutional Real Estate Europe, and I'll be moderating today's discussion. Today, we'll be talking about the European listed real estate market and current trends, and the evolution of the FTSE EPRA Nareit index. And I'm very glad to say that today with us, we have two speakers. Our first speaker is Svetlana Gubri, who is Head of Indirect Real Assets at Aberdeen, and David Moreno, who is Indexes Manager at EPRA. Before we start, I'll outline a few house rules. So there is a chat function and a Q&A function where you can ask questions. Please ask questions as we go along. There's there won't be any formal Q&A session at the end. What we'll do is we'll either respond to these during the webinar at some point, or we'll get back to you after the webinar is completed. If you identify yourself, we'll be able to get back to you. If you don't, if you do it anonymously, then we'll obviously struggle to get back to you. So please do identify yourselves if you can. We'll be using slides during this presentation for some of the webinar, and all of these will be sent to the attendees afterwards via email. There'll also be a recording sent to you that you can listen back to at your leisure and share with any colleagues if you wish to. This webinar is scheduled to last for about an hour, and we hope to finish pretty much on the dot. We may finish earlier depending on how we're doing with Q&A. So yes, welcome David, welcome Svetlana. Great to have you with us today.
Thank you, Marek.
You're very welcome.
Thanks, Marek. Good to have you.
Absolutely. Okay, I think to start off with, we should perhaps paint the landscape a little for our attendees. So I think, David, could you perhaps provide a brief overview of the FTSE EPRA Nareit Global Real Estate Index series, how it's composed, and what our attendees today should know about it?
Sure, absolutely. Let me share a few slides that will help us to get an overview.
Yes.
Do you see my screen now?
I can see it. Yeah, looks good. Yeah.
Okay. All right. Perfect. Okay. So thank you everyone for attending. This is just a very short overview of the FTSE EPRA Nareit Global Index Series. So basically, first of all, it's important to mention that this is a partnership that works very well between FTSE Russell, Nareit, and EPRA. Is the main benchmark for the listed real estate industry global, basically covering both developed and emerging markets, where one of the key points that makes the index quite successful is actually the very strict criteria for inclusion, where some of the most important criteria are basically the EBITDA composition, where at least 75% of the company's EBITDA needs to be derived from real estate activities. And of course, there is a completely set of rules how we define what is eligible and what is not, and also the geographical exposure. So being a real estate index, location matters. So that's actually one of the key points, how we map all the companies and we filter the ones that are actually eligible for the index. So as December 2023, this is the picture as end of the last year. The global index was composed by 495 constituents, representing 1.6 trillions in free float market cap. This index is basically decomposed between developed and emerging markets, and 3 geographical regions are divided here, split. So we have the EMEA region, composed by 149 constituents, both from developed and emerging markets. The Americas region, 141 constituents, and the Asia Pacific region with 149. So focusing on the developed index that actually represents more than 80% of the global index, being the emerging markets, the smallest region. We have 365 constituents and roughly 1.5 trillion in free float market cap. And in the developed index, basically we focus on the EMEA region, where we have 110 constituents and 204 billion in free float market cap. So basically, the EMEA region represents around 14% of the total developed markets. And basically, this is the regional index where we'll be focusing today. So most of the comments are going to be related with the developed Europe index, that is the main benchmark here included in the EMEA region. And we are going to have a short look at the composition of this index. So here, very short picture on the way how the index is composed. So here it's interesting composition that of course has been evolving with the years. Here on the left, we have the composition by sector, where we can see that roughly 29% of the index is composed by companies that are classified as diversified, which means they have exposure to at least two property sectors, where no sector it's representing more than 75% of the properties portfolio. So 29% of the companies are diversified in different property sectors, and the traditional real estate sectors like residential, industrial, retail, and office basically represent around 54% of the index. So basically, it's still significant the exposure to the traditional real estate activities. However, it's also interesting to see that in the last very few years, the exposure to the alternative sectors, such as self-storage, healthcare, lodging, and even some specific subsectors in the residential, like social housing, senior housing, student accommodation, has been growing. All the exposure and the companies involved in these sectors have been growing significantly. Now they represent more than 12% of the index together, which is a significant growth compared to a decade ago, when the alternative sectors represent less than 3% of the index. So actually, in terms of the evolution, how the index composition looks now, it's a very interesting picture. And in terms of the sectors, in terms of the countries, we have the UK being the dominant country with 32% of the exposure. Germany and the Eurozone, it's the second group, with being Germany, Germany, France, Belgium, and the Netherlands, the main countries in the Eurozone with the largest exposure, together with France, with Spain. The Eurozone basically represents around 60% of the index, and Switzerland and the Nordics represent also a significant proportion. So basically, in terms of the geographical exposure, as you can see, we have different countries, different currencies as well, being the pound, the euro, and the Swedish krona, and the Swiss franc, the main currencies affecting the evolution of the index. So as you can see, it's the developed Europe index is quite diversified in terms of geographies, in terms of sectors, and also in terms of currencies, as we can see now.
Fantastic. Excellent. Thank you. Thank you for that, David. Yeah. Yes, as we can see, a fantastic mix there of sectors and countries. Yes, we've had a comment here saying it's interesting to note how Belgium punches above its weight thanks to its excellent sector diversification, which is an interesting point. I don't know if you wanted to comment on that now, David, or perhaps in a bit. But yeah, I suppose a country like Belgium will have a lot of ability to host a lot of good real estate. So that's probably explains that. Well, let's move on to the second question we have, which is aimed at both David and Svetlana, which is how have the indexes performed so far in 2024, the European ones we're looking at, that is, and what trends can we potentially observe within certain sectors and geographies within Europe? And perhaps within that, we could maybe comment on mention the comment raised about Belgium punching above its weight, if we want to.
Yes, absolutely. So in terms of performance, first, it's important to mention that 2023 was a very strong rebound after a hard 2022. So last year we had a strong recovery of 17%, 17.4% in the developed Europe index. That was following a hard year that was 2022, where the increase in interest rates and the inflation have a strong influence on the performance. I think that the inflation is an interesting point to discuss in a while. Basically, the increase in interest rates was a strong driver in 2022 and in 2023, when most of the central banks start providing guidance of eventually easing their monetary policy. Basically, that also helped the sector to get a very interesting recovery, where 70% was a strong outperformance compared to the other regions. And in 2024 has been a more prudent year with some corrections and some stabilization. So basically, the figures until February by sectors, you can see that there were some of the sectors performing as slightly negative, some others a bit more. In terms of the specific sectors, the office sector and the self-storage presented some corrections. Actually, it was very interesting to see that self-storage was one of the sectors that was highly resilient during the pandemic, and also in 2022 when we have the impact of increasing interest rates. And the retail sector as well was one of these sectors that was under high pressure before the pandemic, and after the pandemic actually has been one of these sectors that has been performing quite well. So in 2024, basically the first 2 months were slightly negative, and March has been quite positive so far. So just yesterday I was checking the figures, how the performance was until the close of business yesterday, and we got plus 8% on the continental index and the developed Europe index. So basically the end of quarter results are going to be slightly negative or tight, with very limited return, close to zero in most of the sectors. Basically because March has been again a recovery. It's a time of high uncertainty. Basically, it's the main question for many investors and analysts and even the property companies is the interest rates are going to decrease, but when, and the economic growth, how it's going to be across the different regions. So of course, everyone has a different opinion, and it's a matter of uncertainty, but also stabilization in the market. 2022 and 2023 were quite volatile, but this year has been much more stable. And generally speaking, we have seen some very interesting trends. Basically, in terms of property valuations, the valuations in the property portfolio owned by the listed companies have been affected by the interest rates. Of course, the more level of discount for properties valuation is affecting the higher level of interest rate to discount the properties cash flows. Also, of course, affects the valuation, but actually it has been smooth, it has been gradual, hasn't been dramatic, has been a very smooth impact. And actually, many of the companies have managed to maintain a strong rental growth. Indexation has helped a lot to many companies to keep profitability in a very decent levels, very, very strong performance. And of course, the higher debt cost is also a question, because we are going to discuss in a while the debt. But of course, we came from several years of very low financial cost, very low interest rates. And now they are adapting to the new environment, adapting to the new level of interest rates and inflation. And it takes time, but the property companies are doing very well on that direction. So basically, this has been one of the most interesting points to see, that in spite of higher financial cost and negative property valuations, companies' profits have been resilient, and most of the property companies and REITs continue evolving and adapting to the new environment, and they have been quite successful in doing so. And finally, some additional comments on the performance. Basically, some of the additional trends that we have seen is limited development. So a super high construction costs for sure affect the projects for many developers, and basically scarcity of land, limited licenses for many sectors, especially industrial properties and logistics. The supply of new properties has been quite limited in the last few years, and that has been one of the points that actually has supported the landlords and the rental growth. So actually, every single trend has positive and negative parts of it. And in this case, the rental growth has been one of the most important drivers for most of the companies. So right now, there's a lot of mismatch between the private, direct, and listed real estate. Basically, the property valuations and the direct real estate market is still in correction, and the listed already had that correction in 2022 and recovered in 2023. So actually, we are in the stage of stabilization, while the other markets are still showing some corrections. So basically, there's a lot of different drivers and trends affecting the industry right now. But basically, most of the property companies, the listed property companies, have been quite resilient during the last few years, and in particular, 2024 has been much more stable in most of the cases.
I would agree with David that 2024 potentially has a chance to become a year of stabilization and normalization to a new normal, whatever that new normal might be. But I think before we start talking about 24, it's very important to think about 23. It was a very volatile year. First of all the economists in the world were wrong. We didn't see global recession. It didn't happen. At the end of last year, a lot of economists and investors started expecting very aggressive interest rate cuts across the developed markets. It's very unlikely that it's going to be the case, but all those factors impacted performance. But another interesting element that, on one hand, global economy continues to perform much better than everybody expected. We also witnessed a very remarkable strength of the consumer, despite rising interest rates. And we also continue to see growth in Magnificent Seven. Technology continues to dominate the market, not only from the investment perspective, but also from the economic perspective. And not surprisingly, real estate and listed real estate performance reflected all those trends. So we've seen globally, we've seen sectors that have exposure to those new technology trends, companies that have exposure to changes in the world order, i.e. supply chain reconfiguration, performed really well. And effectively, we're seeing that all the negative expectations around consumer didn't come true. and companies with consumer exposure continue to perform quite well. And as David mentioned, higher interest rates continue to restrict supply. And in some sectors, we are back to historically low supply levels. And all of that actually provided very strong support on fundamental level. That rental growth that David was talking about, all of that is coming from much stronger economic drivers. But the wrinkle on this story is interest rates, obviously. And while right now we are still in a relatively good shape, there is a big question that investors is asking. In 2-3 years, what will be prevailing interest rates and what will be refinancing costs for the companies? And as a result, if you look at the performance year to date, you'll see that sectors with more exposure to more stranded balance sheets with higher leverage actually underperformed. The investors are starting to look again at the strength of the balance sheet, not from the LTV perspective necessarily, but from the future refinancing cost and the impact on earnings 2-3 years from now. So you can see that. And the first point that I mentioned, exposure to newest sectors, you can see the difference. I think, David, you may have a chart showing performance of different regions. This is actually one of the reasons why Europe continues to underperform North America because of the difference in index composition. In the US, we do have much higher exposure to alternative sectors. We have much higher exposure to new technology sectors like data centers. And all of those factors have a very significant impact on regional performance. So looking just at the top line, Europe versus US doesn't, or Asia doesn't necessarily give you the picture of underlying real estate. It actually also tells you a story of sectors underneath those countries, and also it tells you the story of the types of debt and balance sheet in those regions.
Oh, you're on mute, David.
Sorry, that's a very interesting point indeed. Actually, I have one slide on the topic Svetlana was mentioning on the diversification. So as we were saying before, a large proportion of the developed Europe index is actually the diversified companies, which is not the case in North America, where in North America this is US and Canada. Basically, the diversified companies represent just 2% of the index, because basically there is a trend for more specialization in one specific sector there, and more diversified companies in Europe, which is not an issue by itself, but indeed exposure to some other sectors that are driven by some of the mega trends observed in technology, for instance, like data centers. It's actually a point that it's missing in Europe. So basically, there are very strong efforts by few companies on start investing in data centers, but for instance, the sector itself represents almost 12% of the index in North America, while we don't have a specific data center specialist in Europe. So basically, that's a very good reason for the difference in terms of performance, where definitely the exposure to these sectors, it's a key factor. The self-storage sector in the US represents almost 9% of the index. In Europe is less than 3%. The lodging and resources also a bit bigger in the US than in Europe. So actually, what we have seen is this is one of the reasons to understand the difference in terms of performance, where definitely the 2023 was very strong for Europe, but when you take a bit longer picture, basically starting from the pandemic, and you accumulate the returns starting from 2020, basically there is an underperformance of Europe compared to North America, and basically this is one of the most important reasons, and it's important to have in mind this difference, because basically that's also one of the points that actually most of the property companies are working on now.
And this is just one point. This is actually a very interesting point. Since we're talking about evolution of the indices, the challenge for Europe is over the next several years to make sure that the index and listed real estate industry is representative of the economy, of how people live, how people work, and not just being a stale, old school, passive landlord type of index. We're not. We had a very long evolution from that point, but I think there will be there should be more changes, because at the end of the day, real estate is always a representation of the economy and how the business, real estate business actually works.
Absolutely. Yes. Thank you, Svetlana. Okay, the questions are flying in, which are all actually relevant to points you've made. And actually the third question I was going to pose to you both. So I think perhaps we might pick up on one question that's come in, which is which touches on the refinancing point that you were talking about, Svetlana. And the question is, how has the impending loan facilities maturities affected the various property type returns? So which property types in the commercial real estate sector have been most adversely affected? Obviously, there's a lot of potential risk coming up along the track when it comes to refinancing. We all know that. Are there any particular property types that are more exposed to this problem in your view?
One sector that comes to mind is offices, and there are we can spend hours talking about the offices. There are some common threats to the sector on a global basis, but there are also very important differences between the US and Asia and Europe. So we're all reading horrifying headlines about suburban office in the US. But if you look at the data, the reality is prime European offices have much better utilization than the US offices. European offices in general are much younger as assets compared to some of the US offices. So there are some differences, but nevertheless, a lot of lenders are trying to protect themselves and stay away from that sector, or use very strict lending criteria when it comes to that sector. Apart from that, there are no we are not seeing any big differences across the sectors. Obviously, there are some favorites like industrial, but from the lending perspective, but residential as well. But the main factor, and this is something that a lot of investors that invest on both private and public side may forget, balance sheets of listed companies are in much better shape than we were in 2008. It's a completely different story. And I know that David has a chart on that, so we'll come back to that. But one very important point of difference is that the sources of debt capital are very different today than they were in 2008. So in addition to investment grade lending, that much bond market being open in Europe more today than it was 15 years ago. We also see private credit playing in real estate. There are different views of what it means and whether it presents a risk longer term. We're not going to go into that discussion right now, but from real estate perspective, it's an additional source of capital. And in many cases, that source of that capital has actually a relatively low cost of capital. So the lending the lending window is open. It's a question of cost, how much you as a borrower will have to pay. And this is the big question mark that faces not just real estate, it faces all industries. David, I can see you're ready with the chart.
Yeah, absolutely. That's a very good point that you are mentioning, and that's something that we have been trying to highlight, because indeed it's important to see the differences between previous crises, especially the great financial crisis in 2008, 9, 10, and now. So basically, real estate was a big part of the crisis. In 2008, the listed property companies were much less involved than the rest of the real estate industry, but the evolution after that has been very important and very clear. So here is just a short description of few elements in terms of the debt profile and how the companies have made strong efforts to improve the debt profile. So when you see the level of debt compared to equity that was in 2007 and 8, that it was clearly a massive proportion of debt, and the capital was much less, has gradually decreasing, and now we have a much more balanced structure. Also, in terms of the proportion of fixed interest rate debt over the total debt, when you have a very low interest rates in the last couple of decades, basically, then you have an impact of increasing interest rates that is actually much lower than it used to be when the proportion of floating interest rate was much higher. And same story with the level of the debt you were paying, the cost when you check the interest over debt, the proportion is still quite low. Of course, is gonna increase gradually in the future because the interest rates environment change, but it will take time. It's not something that immediately happens. And the property companies have been working on this and preparing for this kind of environment from a long time ago, and it's a clear effort as an industry to work on the balance sheet and to improve the profile. And something in addition to this, very close related, is the expectations on interest rates. So here what we have is basically the proportion of debt and basically bonds and loans maturing in the next 15 years. And as you can see, 24 and 25 are basically less than 20% of the debt. The big proportion of the debt is actually maturing between 2026 and 2028. And for sure, this is a period where it's very difficult to forecast the level of interest rates. But what is almost sure is that the debt maturing between 2024 and 2026 is going to be maturing at some levels of interest rates that are actually lower than now. So now we are almost at the peak of the interest rates because the central banks were increasing the interest rates to control the inflation. And right now is the highest level of interest rates that we have seen in several decades. But it's actually the peak, and as Svetlana was mentioning, there is a lot of expectation on when and how the central banks are going to decrease the interest rates. And it's very likely that the debt that is going to be maturing in 2025 and 2026 is actually going to be replaced by debt with higher interest rate, than the one maturing, but not as high as now. The level of interest rates is going to be decreasing in the next couple of years. So actually, many companies are already working on this, are already managing their capital and their cash to be prepared for the debt maturing, trying to get the best exposure they can to the good financial conditions and strong relationship with the bond tenants and with the banks. And actually, as you can see here, is a matter of time to replace the debt, but it's not an immediate situation that you are going to face a dramatic amount of debt maturing in 2025. It's basically gradually 2025, 2026, 7, 8 is a period that gives enough time for all the companies to be prepared and to work on the debt and replace it for longer debt. So of course, it's a source of capital. The business continues growing, the markets continue giving opportunities, and the companies continue taking debt and using the debt efficiently for growing the business. So it's not a matter of concern immediate that the debt is going to mature, but it's also an opportunity for growing in the future. So actually, it's a very interesting point to see the expected trend in interest rates compared to the expected debt maturity that we will have in the next few years.
Yes, excellent. Thank you, David. Yes, well, as you both mentioned, I mean, Svetlana, you did mention LTVs, and they're obviously a lot lower than they were generally when it comes to comparing our period with the GFC, and then balance sheets are much stronger, as you mentioned, Svetlana. We had one, oh, by the way, everybody, we will try to get through all your questions if we can. If we don't, I did mention at the beginning, for those of you who didn't join us at the beginning, we will get back to you with any questions. If you identify yourself when this webinar is complete, we'll try to get back to you as soon as we can. There was one question, which I guess this one's for you, David, is EPRA often puts forward research showing that listed real estate is not well correlated to interest rates. But in the last few weeks, we see that correlation closing to 1. And this even applies for sort of good real estate with low leverage and or being well hedged. And the question is, how is that? Why is that? How is that happening? Is that something you want to answer now, or should we park that for later?
Yeah, absolutely. It's fine to cover it now. So in terms of correlations, it's important to have in mind that correlations, first of all, are dynamic, are not always the same. They evolve. And second, the period that you use for the correlation and the frequency really matters. So for instance, if you take weekly data and you correlate data on a weekly basis during 1 or 2 years, basically the correlation is going to be very high comparing all the financial markets, because information and noise it's very frequent in the markets, and you have information that is affecting the trading activity of all the public instruments all the time, and basically that creates noise that it's correlated with the other markets. So of course that's something that always happens, and it's something that you will see always, and it's difficult to make investment decisions using that kind of information. So if you're using very short-term information for a long-term investment, that is basically the idea on real estate, basically is going to be quite misleading, and then you need to clean a bit more the data, and you need to have a much longer horizon and more reliable data. So basically, using very short frequency data, it's quite risky. Of course, sometimes it's necessary, because you cannot use annual data forever and have only 4 or 5 or 10 data points and compare correlations that never change. Of course, you are going to be behind the market trends all the time if you do so. But if you rely too much on short-term data, it's also an issue. So basically, it's a matter of understanding the trend, the mega trend, and also the short-term trend, and see when the correlation makes sense and when you can rely on them or not. So generally speaking, what we have seen is when you take long-term trends, yeah, the impact of interest rate is quite limited, of course, because we also had a very long period of very low interest rates, that of course the impact of such movements was difficult to see when the interest rates were increasing to the levels that we have now. Basically, we haven't seen these levels for almost 30 years. So it's a matter of how the trend behaved in the past and also how it's going to be in the future. But as we were mentioning before, most of the companies are already working very hardly to control their debt profile, to improve their debt profile, and so the impact of the interest rates is also quite limited. So I would like to see the evolution of the correlations in few months, maybe a couple of years, to see once you clean the noise and once you see actually the complete cycle changing, so increasing and after decreasing, then how the correlation looks like. Because for sure, right now, it's a bit difficult to measure, but it's interesting and it's a discussion that has points on both sides and always will be relevant because it's part of the business.
May I add one point as a practitioner? I find correlation analysis quite often not very useful in portfolio construction. It's an excellent academic tool, and it allows you to get to understand better what drives the market, what drives the performance, etc. However, from a practical standpoint, in terms of the stock selection, asset allocation, I actually find it quite often very misleading. I will be very honest about this, exactly because of the point that David is making, that correlation is not static. It changes over time. Also, effectively, the best way to think about this, at the point in time when interest rates, balance sheets are the most important factors that drive performance, you will see increased correlation. At the times when you have other factors, other drivers of the performance, correlation will be with interest rates will be very low. So it's an interesting data point, but I wouldn't be necessarily making asset allocation decisions solely based on this.
Thank you both. Okay, and we have another question which ties back to the index composition point, I think. I'll read it out. How many new issues or secondaries have there been over the last year or two? And is there an issue with accessing public equity markets as we see in the UK? Who wants to... I guess that's asking how difficult it is to get onto the index. Is that right in Europe? Or am I misreading that?
The way I would interpret the question, and please, whoever asked the question, if you don't agree with the interpretation, just
please comment.
Feel free to correct. But I would interpret this question as access to capital.
Okay,
how easy it is for companies to issue capital, issue equity. And there are several elements there. And it's actually a very important and maybe long discussion, but I will be short. So in Europe, a lot of time issuers and the boards of the companies are very focused on NAV and NTA when it comes to issuance of equity. So in the market where listed companies are trading at discounts to NAV, decision to issue equity could be a very difficult one. However, as an investor, I think we are also going through evolution of our understanding what creates value. So ultimately, the job of the management teams, the job of the companies is to create value. And real estate is a capital-intensive business. And this is actually, especially in this market, this is an advantage of public companies, that they have access to equity capital, as opposed to some of the private funds that may have difficulties raising capital from the investors today. And if you, again, going back to global comparisons, if you look at the US, for example, where the practice of equity issuance is very different from Europe, and I'm not saying whether it's a good or bad, but historically, we've seen that US REIT market was able to grow much faster, was able to access capital much quicker. And that, I would argue, is one of the reasons why US market, America's market, is larger than Europe, everything else holding equal. But today we are seeing a number of issuance of equity by European companies and UK companies. So I wouldn't say that the market is closed. I would actually argue that the market is open for the right companies with the right reasons to issue equity.
Right. Yes, our questionnaire came back actually. The attendee posing the question, excuse me, saying that just to clarify, it was new IPOs. So the point is that it becomes hard for people to get excited and engaged with the sector, and huge discounts to NAV don't help this vicious cycle. Okay, well, we can pick up on some of these points and some of the other questions later on. I think it's given the time that we're on now, perhaps we'll move on to maybe ask whether some investors still shy away from listed real estate due to its volatility. Obviously, we've looked back at 2022 and 23, and we're looking at a more stable 24, or could they benefit from more exposure to European REITs? And if so, then how?
I'm happy to start. Some of you may think that I will be very controversial, but I will say that this volatility in the current market could present a very significant tactical advantage for the investors. Because if you go back to classical asset allocation theory in real estate, when you combine, when you do a hybrid portfolio and you combine direct private real estate with listed core and satellite approach. 15 years ago, it was a very popular way to construct institutional portfolios. So if you think about this, if you have this approach and you have heightened volatility in listed sector due to macro factors today, if you are in that market and you continuously rebalance your portfolios back to your target weights, you might be able to pick up a significant alpha by using this volatility. So the way I'm thinking about this, and I think that a lot of this strategy could work for a lot of investors, design your portfolio with a target allocation to listed European sector, private investments, and think about listed exposure to Europe as a way to dial up and dial down, depending on the performance of the sector. So this is the tactical element. But another very important point, and again, we talked about this quite a lot today, is given the current valuation of the listed sector, given the underperformance that we've seen over the last several years, I would argue that listed real estate right now represents a very interesting strategic, could represent a very interesting strategic part of asset allocation as well. So I would say that volatility is there, but if you approach it from a slightly different angle, it could actually benefit portfolios.
Yeah, and I know, David, that EPRA has been involved in some recent studies looking at things like volatility, asset allocation, systemic risk, in listed markets. What have you learned from those that can sort of inform us on using REITs within a real estate portfolio?
Yeah, actually, that's a very interesting and important topic, and actually something to complement what Svetlana was mentioning is that volatility can always be managed and hedged, and there are many different ways to do it. You can do it with the allocation, or you can do it with proxies. But actually, we have seen more instruments becoming now available for investors to manage that volatility without affecting significantly the allocation, or to use the allocation or the instruments to improve the tactical allocation. So just to mention that few days ago there were new features launched in Eurex, covering actually the FTSE EPRA Nareit indexes, developed Europe, Eurozone, UK, where these are exactly the type of instruments that you can use actually to hedge or to improve the location that you have in the market. And so the volatility is not necessarily an issue if you manage it, or it can be an opportunity, as Svetlana was mentioning. It can be both sides, and of course, it's the way how you approach the situation and how you approach the topic. And the studies that have been performed are also very, very useful. Let me share again the screen to show a few of the slides. And it's a very interesting and useful topic, because it's something that we have seen in the past in terms of allocation and performance and so on. Do you see my slides now?
Yes, we can see them. Yeah, thank you, Doug.
Okay, good. So this is a study that was performed by CM Benchmarking last year. Basically, this is a Canadian institution that works basically, as the name says, benchmarking portfolios of several institutional investors around the world, and they have been working on this type of studies with EPRA and Nareit for a few years now. And these are very interesting results, because actually when you compare the actual allocation and results and performance of several institutional investors, in this case mainly focus on pension funds, what you see is that actually listed real estate has a very strong performance and net return compared to the other asset classes. So for instance, the private equity asset class, it's usually a very profitable one, but it's also a very expensive one. So when you compare the net returns of listed real estate with other asset classes, actually the returns during the last 16, 17 years have been quite outstanding. And listed real estate has been one of the asset classes that has provided the highest returns for the investors, and also the volatility that can be managed. It's also an opportunity for adjusting the asset allocation and taking advantage of the opportunities that this represents. So here in this study, basically, CM Benchmarking was covering the portfolio allocation of 3 different regions: the Dutch pension funds, the UK ones, other Europeans, where the Nordics have a very strong weight, very significant weight. And as you can see, the results were quite interesting, and the net returns from the listed real estate allocation were significant. And also, when you compare the evolution of the allocation to listed real estate, what we have seen in this study is basically the allocation to listed real estate has been gradually increasing at the time, especially in the other European funds. The Dutch funds have always had a significant allocation to the sector and has been quite stable. And roughly speaking, the allocation is still below the optimal levels suggested by most of the studies. So when the studies, both by market practitioners and also by academics, here are some examples like Oxford Economics and University of Cambridge, In both cases, depending on the risk appetite of the investor, and of course the limits on the asset allocation they have, basically the optimal level usually it's in the range of 9% to 24%, depending on the risk appetite and the horizon. And in this case, basically what we see is that the allocation is consistently below the optimal level. So the optimal level starts at 9%, and most of the institutional investors, especially the pension funds in this case, have an allocation close to 5 or 6%. So basically that means that from the optimal level, there is still a lot of space to grow. The institutional investors have a way to increase the allocation and to reach those optimal levels that for sure would fix the level of risk appetite and constraints that the portfolio have. But this is something that has been very useful in the past, and it's something that we can use very often, because to track the allocation of a global industry or continental industry is quite hard. But by doing so, we believe that it's an interesting way to see how might be the future in terms of the allocation and the role that listed real estate plays in the portfolio of several institutional investors.
Yes. We've had a question come in about some of those numbers, David, saying those numbers might look quite different if you include 2022 to 2023 performance, which I guess is a fair point. But I suppose your answer to that would be that we had a sort of black swan event that's tipped everything upside down. How would you answer that?
Yes, that's true, but it's also a matter of the lag, because here, as you can see, it's a combination of several private and listed asset classes. And of course, to make them comparable, it takes some time to get the data, because most of the private asset classes take several months to report. And of course, to compile of that amount of information takes time, and also to make them comparable. So CM benchmarking does is they apply a very strong methodology to make comparable all the asset classes independently if they are listed or private. And that also takes time. And of course, the 2022 data, I believe CM benchmarking has the data just a few months ago, and the 2023 is not ready yet. That's also in the future going to be part of an update for sure, because this is something that we need to continue monitoring. This is not a one-off picture. It's also evolving, and for sure, when you include the performance of the last couple of years, the allocation might vary as well. But the optimal levels, depending of the time, are mainly stable. So something that we have seen is most of the studies looking at optimal allocation levels, both from universities, academics, and market practitioners, most of them are guiding in the same point, and is basically the current allocation is still below the optimal level.
Mm-hmm. Okay. Right. Conscious of time, we've got 2 minutes left. We'll squeeze in one more question from our attendees, which is an interesting one, I think. I'll read it out. Isn't allocation to listed a function of regulations such as Solvency II? It's about return on risk weighted regulatory capital, not absolute return on capital. Could you answer that in a minute or two, Svetlana, David?
I'm happy to start. A short answer is yes and no. It depends on the investor, obviously. So we're talking about institutional investors here. But if you use some of the retail investors, wholesale investors, or wealth managers, that you can argue that they are, in many cases, many institutional investors, given the way they make decisions, they still will be under-allocated to the listed real estate. And I think, obviously, regulatory environment plays a role. But I think we as an industry will need to do more to educate investors, to educate wider audience of benefits of diversification. It may sound like a simple concept, but sometimes it's being lost.
David, any final thoughts from you on that question?
Yeah, basically that's also very true, that basically regulation gives you some limits, some guidelines, but not the decision by itself. So of course, Solvency II and all the capital requirements will guide you on the right direction to make the things right, but not necessary to make the decision and the final point. So for sure, something that we saw a few years ago was a significant change in the capital requirements for investing in listed real estate, and that was a great result that is actually beneficiating the industry. But it takes time because it's long-term perspective, and you cannot judge the results of a regulation that has a long-term perspective in the short term. So I believe it still needs time to make clear that the allocation affected by Solvency II and all the other changes will be affecting the allocation directly for the portfolio managers in the long term. So we still need time to see that.
Excellent. Well, thank you both. Thank you, David. Thank you, Svetlana. It's been a really, really interesting discussion, I feel. I hope our attendees feel the same. Apologies again to anybody we haven't been able to get back to on the Q&A, but we will do as soon as we can. And as I said at the beginning, please look out for the email, which will have a recording of this webinar and the slides that were shown on it today as well for you to look through at your leisure. So thank you again. And we hope to see you on the next one before too long.
Thank you.
Thank you very much.